Welcome to PFS. In this video, we will talk about the covered interest rate parity. And covered interest rate parity is based on the arbitrage relationship among the risk-free interest rate, the spot rate is actually the spot FX rate, and the forward rate. So, take an example where investor faces a scenario where he can invest his $1 at the rate of domestic interest rate. For example, the domestic interest rate is ID. So at year one, the investor has a domestic currency of 1 plus domestic interest rate. In case of scenario 2, the investor can convert his $1 into a foreign currency at the rate of spot exchange rate. Then he can invest that foreign currency at the foreign interest rate and simultaneously have a forward contract to convert that foreign currency into the domestic currency at the rate of F. The two scenarios are risk-free and should yield the same result. So if we equate this scenario 2 with the scenario 1, we will eventually get the forward interest rate formula where forward interest rate equals to spot exchange rate multiplied by 1 plus foreign interest rate divided by 1 plus domestic interest rate. Obviously, we are taking an example where the duration of the forward contract is 1 year. So we can refine this formula is 1 plus foreign interest rate to the power t divided by 1 plus domestic interest rate to the power t multiplied by spot exchange rate. So if we take an example where we are domiciled in euro and 1 euro equals to 1.2 US dollar is the spot exchange rate. Then if we take the interest rate of euro equals to 2% and interest rate of dollar, which is the foreign currency, equals to 5%, then question is what should be the forward rate for euro. So at time 0, in case of scenario 1, the domestic investor can invest his 1 euro at the rate of 2%. So at year 1, he will have 1.02 euro. In case of scenario 2, at time 0, the domestic investor can convert his 1 euro into $1.2 and he can invest that $1.2 at the interest rate of 5% for 1 year. So at year 1, he will have $1.26. At time 0, the investor can have a contract with the counterparty to convert that $1.26 into euro. The question is, what should be the exchange rate? What should be the forward exchange rate? So if the investor convert this 1.26 at the rate of forward exchange rate, he will have the amount $1.26 divided by forward exchange rate. And these two scenarios are risk-free and should yield the same result. So 1.26 divided by forward exchange rate should be equals to 1.02. So if we solve this equation, then the forward interest rate should be equals to 1.235. So we can see that euro in the forward market is trading at a premium. So if we see at how much premium the euro is trading in the forward market, then we can divide 1.235 by 1.2 and it should yield 2.94%. So this is roughly 3% premium. So in the forward market, euro is trading at 3% premium over the spot exchange rate. So question is, Where does that 3% comes from? So in case of covered interest at parity, the relationship is very simple. The currency whose interest rate is higher should trade at discount in the forward market. The currency whose interest rate is lower should trade at premium at the forward market. The next question is, how much should be the premium or discount? The answer is, the premium or discount should be the interest rate differential. In this case, foreign interest rate is 5% and the domestic interest rate is 2%. So the interest rate differential is 3%. Since the interest rate of euro is lower than the interest rate of dollar and the interest rate differential is 3%, so that's why the euro is trading at 3% premium in the forward exchange in the forward market. What will happen if the forward rate doesn't equal to 1.235? Then an investor will have the arbitrage transaction based on the forward exchange rate. If the forward exchange rate is above the 1.235, then investor can sell the euro in the forward market, because in the forward market the euro is trading at higher than what should be the price. So the bottom line is, the covered interest at parity describe about the arbitrage relationship between the risk-free interest rate, spot exchange rate, and forward exchange rate. And the currency whose interest rate is lower should trade at premium in the forward market. And the premium or discount should be equal to the interest rate differential. Thank you for watching the video.